Welcome to the InterMarket Analysis video update. This is a video that I do once a week where I look outside of the S&P 500. We also look at other indexes within the stock market and other sectors. And then we look outside of the stock market. We look at interest rates, we look at commodities, because no market exists in a vacuum. So we can look at the interaction of these other markets to how they're actually impacting the S&P 500 to give us some insight that we may not get otherwise. This is being prepared for Monday, October 23rd. The first area that we look at is like the Christmas Carol. We look at past, present, and future. We look at the valuation of the S&P 500. We look backwards to see historically what have earnings been at different levels while the S&P has been going up or down. We look at that for present because we're also focusing on the future, and that's what the market looks at to justify either higher or lower prices. The first chart looks back, and this is called the trailing 12 months. And this goes all the way back to 1980. The black line is the S&P 500. The red line, the blue line, and the green line, these are different price to earnings ratios. When we get above the red line, the market is considered to be expensive. When we're at the blue line, it's fairly valued. When we get to the green line, it's considered inexpensive or cheap. Well, for quite a while now, the S&P has been overvalued on a historical basis. We don't usually use this to make day in and day out decisions, but we can look at the market as a whole and say, yeah, it's expensive, but it doesn't really have a big day-to-day impact on what stock prices do. Plus, we also look at this in a different way that seems to make things more justified. We also can look at this in the context of different historical things that have happened. We have the 1987 crash, the dot-com boom and bust, the housing crisis, and then where we're at right now. And yeah, we continue to be overvalued on a historical basis. We also look at another way of measuring historical values by a thing called the Shiller PE ratio. And this looks at an average over a period of time. You also may hear this referred to as CAPE. Right now, the Shiller PE ratio is coming in at 28.87. To give you some context, we can look at that historically to see, okay, we were at about 30 in 1929 before we had the stock market crash. We were down between about 18 or so during the 1987 crash. So historically, looking back, we are overvalued. We can also compare that to the median and the mean, where this is between about 16 for the median and about 17 for the mean. So this is also suggesting that the market is overvalued. But the market doesn't look at that way. They like to look forward. They go on what the analysts come out with forecasts and predictions and what they think is going to actually happen. So when you look forward, the S&P is coming in with a PE ratio looking forward right now at 17.5. That's as of Friday's close. We also look at the mid caps. They're coming in at 12.5. That's under the 15 and above the 10. So they're not necessarily considered overvalued looking forward. The small caps, which have been under a lot of pressure, they're coming in at 11.7. Then we put all of this together on one chart, the S&P 500, the mid caps and the small caps, and they have a real strong tendency to go in the same direction. So we can get a visual look at how they're moving with each other. Then when we look at small caps, we have two different indexes that we look at, the Russell 2000 index and then the S&P 600, and they measure things slightly differently. The red line is the Russell 2000, and that comes up with a different figure. The blue line, that correlates more with the 10, 15, 20 scale that we use, and this also just gives us an idea of where things are at looking forward for the small caps. Then another area that we look at is growth and value, where we look at just the growth index in and of itself. It's been under some pressure lately, but the blue line is still above the red line, so it's in a longer-term uptrend. Then we look just at value, where it continues to be in a downtrend. And then we do some analysis. We do some ratios between the two, where on the top, this shows that growth is outperforming value. On the bottom, it shows where value is underperforming growth. One of the reasons I look at a lot of different measurements of growth and value is that we have indexes, we have ETFs. There are different ways that these are calculated. And when you take the same index and flip it upside down, you can see when we had a moving average crossover here, they actually didn't occur at the same time. There was a little bit of a lag. So we just want to get some confirmation by looking at things in different ways. Here's one way, looking at an ETF. This is showing that growth is outperforming value. There's an inverse of that same chart where value is underperforming growth. Then we look at some other indexes where growth is outperforming value, and this shows that value is underperforming growth. Then we look at a different set of indexes that growth is still outperforming. And then we have some different measures as well. This is a growth to value ratio where it's been coming down a little bit, but we're still at the upper side of this longer term rainbow. So for most of 2023, growth has been outperforming value. And that's the idea behind buy low and sell high. When we run into difficult times in the market, that's when folks tend to go over to value. Those are stocks that have been around a long time. They're maybe more established. They may pay dividends, and you're not as worried or concerned about capital gains like you are with growth. Now you just want to get some kind of income. And even though the market may be under pressure, value stocks may end up being under a little bit less pressure. Then we look at a value to growth ratio, also showing how value's been underperforming, even though it's been bouncing back up lately. We look at the small caps and we compare small cap growth to value. It's been chopping sideways, but it's still in an uptrend when we compare growth to value here. Then with the mid caps, this has been showing a little bit more strength in 2023, but now it's continuing to chop sideways, even though growth is outperforming value. This is the one that I pay attention to the most. This is growth to value for the S&P 500, where even though the market's been under pressure, you can see up here how we've been going down over the past few days. The growth to value ratio has been holding up. Yeah, it's come down in Friday's session, but it has been going up overall. This could suggest that there's some under the surface strength in the market. We also keep an eye on inflation. We have a monthly chart of the CRB on top showing that the CRB index is in an uptrend. We have a ratio down below that measures inflationary areas with deflationary areas. When this is going down, that just suggests that inflation is underperforming deflation. We look at the CRB index in and of itself. It continues to be in an uptrend. Then we look at the Baltic Dry Index, and you can see this is starting to spike up and actually crossing back over positive. It had been declining, but this is what does it cost to ship products from one place to another, specifically in the Baltics. If this costs more, they're tending to make more money, and this index goes up. That's also inflationary. Some other markets. Here's aluminum, which continues to be in a downtrend. Corn is also in a downtrend. Wheat is in a longer-term downtrend. Fertilizer's been bouncing back up, but it's still in a longer-term downtrend. Oil, this has now switched over to an uptrend as we have some geopolitical events, specifically in Israel, that are going on right now. And this is really causing some concerns, and so oil prices are going up. Gas prices also are still in a downtrend, but they have been bouncing up recently. Then we look at diesel, which had been going up, is starting to come back down slightly. This is what does it cost to ship products by using trains or 18-wheelers to get products from point A to point B. Heating oil starting to get cold now. This is continuing to go back up into an uptrend. Natural gas also been bouncing back up and not quite at an uptrend, at least yet. Copper, this is a barometer of the economy. It's in a downtrend, suggesting that the economy is looking weaker going forward. We also compare that to gold. With the geopolitical events in Israel that have been happening, gold has been starting to spike up. Copper's been under pressure. So we're seeing this ratio really go down. We look at this again with a longer term chart. That's the black line where this ratio is going down. And we compare it with the 2-year yield and the 10-year yield, where other times they tend to go in the same general direction. Well, they've been quite far apart from each other now, going on a couple of years, as the economy is shifting into a newer, different type of phase. We look at gold, which is still in a downtrend, but since the geopolitical events have been happening, gold has been really going up. This is making a lot of the gold people really excited, but it still hasn't really broken out yet. We look at silver, also in a longer-term downtrend, but it's been going up with these recent geopolitical events. We look at gold on the top, that's the closing prices, and silver with closing prices. And then just to kind of confirm what we really already know, there's a pretty strong correlation between gold and silver, which means they go in the same direction at the same time. We also have a study here where on the top we have the gold to silver ratio, When this is going up, that means gold's outperforming. When this is going down, that means silver's outperforming. We can also compare that to the US dollar index. As a general observation, when the dollar index is going up, that means gold is outperforming silver. Now, both gold and silver can be going up. It just means gold is going up even faster or more. When this is going down, that means that silver is outperforming gold. We've been seeing a lot of strength in the dollar lately, and so the relationship between the two, yeah, they're going in the same direction, but it's starting to trail off slightly here. We look at the dollar, which continues to be in an uptrend, and we compare that with the euro, and I have a breakout chart just of the euro where it's been really falling compared to the US dollar index. Then we look at the Japanese yen, which is also going down compared to the dollar. We have another chart of the euro compared to the dollar as well. Here's a newer chart. This is the euro to the dollar. They're getting down what they call par, when the euro and the dollar are at the same level. Well, it hasn't been that way for most of the time. So now if you wanted to take a trip to Europe, you'd probably get a pretty favorable exchange rate. You might be risking your life with all the geopolitical things going on, but hey, you might get a good exchange rate in the process. Going to Japan, also showing how the Japanese yen is underperforming the dollar. British pound, we're starting to see a death cross here. You want to go to England? All right. It's starting to underperform the US dollar, as the dollar has been fairly strong lately. And that is also putting some of the pressure on stocks. Some different indexes. Here's the equal weight index. When it's underneath this black open, high, low, close bar chart, this is the S&P 500, which is a weighted index. The red line is an equal weight index. And when it's underneath, it shows that it's underperforming. Both have been under a lot of pressure lately. We'll look at the S&P and compare it with a ratio to the CRB index, where the S&P had been outperforming. Now it's starting to pull back and show some weakness, and we're getting really near a death cross here with this ratio. Here's an inverse of that same chart showing how the CRB has been beginning to outperform the S&P. The NASDAQ 100, which has done quite well in 2023, but seeing some recent weakness, it continues to outperform the S&P, which has also done quite well in 2023, but the NASDAQ 100 is holding up better currently. The S&P 100 continues to outperform the S&P 500. The NASDAQ is outperforming the S&P 500. And the NASDAQ 100 and the NASDAQ are shown here, where the bigger stocks in the NASDAQ 100, they continue to really outperform the rest of the NASDAQ. These are the big mega cap stocks that are producing a lot of the gains in 2023. Then we look at the mega cap growth, the really big companies, and compare it with an equal weight index, showing that the mega caps continue to outperform, even though they've been under pressure lately. Then we take a ratio of small caps to the S&P. The red line is showing that small caps are really underperforming. And that's a negative, because in a good, solid environment, we want to see the small caps doing well. They just have not been doing well. We look at another ratio showing how the small caps are underperforming the S&P. The biggest software companies, we're seeing a death cross here now, where we're crossing below the 200-day moving average and starting to look more negative. The mega caps, though, even though they've been pulling back lately, still continue to be in an uptrend. The robotics and AI ETF has really been under a lot of weakness, and it's even under more weakness when you compare it to the tech sector. The Dow Jones Composite Average has been chopping around a lot sideways, showing some weakness. It's still in an uptrend, but another few days of being below its 200-day moving average, and we could see this ratio turn negative. The S&P, and then comparing it with shorter-term bonds, shows that we've been seeing some recent weakness here. When we look at the broad market and compare it with further out bonds, also some weakness, but more in the middle part of the rainbow, where previously we're seeing the S&P coming down to the lower end of the rainbow. Low volatility stocks are in a downtrend. They held up better in 2022. They've been under a lot of pressure in 2023. We do a ratio between the low volatility stocks and the S&P. We're coming down and kind of matching this previous low in this ratio. Will it find some support and bounce up off of that? We're still waiting to see if that's what will happen, or if we're going to break down below this. Then we look at the tech sector and compare it with bonds, where the tech sector has been doing quite well, but has been pulling back lately in this ratio. Then we look at the S&P, and then we have advanced decline line studies for the NYSE common stock, Underneath the declining moving average, we're seeing the same thing for the S&P 500. The mid caps are showing weakness and the small caps continue to show even more weakness. We look at traditional Dow theory, where the Dow's been under pressure, the transports have been under pressure, the utilities, which I include as part of traditional Dow theory, have also been under pressure. When interest rates are going up, that really affects utilities. And we look at the transports. When this ratio is going up, that's more healthy for the market. Well, this ratio is going down, showing that transports are underperforming the S&P. We also compare the Dow and the transports. When this is going up, that means the Dow is outperforming transports. We want to actually see this ratio decline for things to be more positive. We then look at a correlation between the S&P on top and the transports. They're having a pretty strong tendency to go in the same direction, and both of them have been under pressure lately. We look at a new take on Dow theory, where instead of using the Dow on top, we look at the S&P, and instead of using the transports, we look at the NASDAQ, and we're looking for convergences or divergences in here. They're not really showing us anything at this time. The FANG index, which is Facebook, Amazon, Apple, Netflix, Google, and a bunch of other ones, they're showing some weakness, but they're still in a longer-term uptrend. They're below their 50-day moving average. This is a longer-term look where we came up to the previous all-time high. We actually broke out and set a new all-time high, but since that time, we've been falling back. If we continue to fall with the FANG index, we'll be watching to see if this previous low here actually ends up offering support. ARC, which was looking a little bit better, well, now it's seeing some weakness, and we're in danger of seeing a death cross here pretty soon. Then we look at the S&P and compare it with stocks in Europe, Australia, Asia, and the Far East. We're above the red line, which is a moving average. And this is a monthly chart, so this is long-term, where we're still holding up. When we look at this based on price, we're above zero with the PPO, showing that the momentum is positive, but it is starting to turn down as the market's been under pressure. And we look at bonds, where based on price, they are in a downtrend. The World Bond Index is also in a downtrend and could be coming back to test this previous low. But when you compare stocks with bonds on a monthly chart, stocks are outperforming. Bonds are underperforming stocks. Then high yield, which means junk bonds, they've been under pressure lately too, but they're still in a longer-term uptrend. These are investment grade bonds, which are more conservative, and so they don't give as high of a yield, but they're continuing to be in a downtrend. We compare the riskier bonds like junk bonds with more conservative bonds like corporate bonds and even government bonds, and folks are still preferring to be in the riskier bonds because they're giving a much better return, even though there's risk added to holding those. We look at a correlation between stocks and bonds, and they're having a pretty strong tendency to go in the same direction. So if stocks are going up, bonds are also going up, and vice versa. We look at the Dow Jones Corporate Bond Index, which did give us a death cross here back in September, and they are seeing some weakness based on price. The 10-year yield is really starting to break out. We actually got a little bit above 5% in Friday's session, even though we closed down off of that, and that's really causing some pressure on the market with interest rates going up. Here's another look at the 10-year yield, where for a long period of time, we saw a series of lower highs and lower lows as interest rates kept going down, down, down. Now they're starting to go back up. And are we seeing a shift in the overall long-term climate with interest rates, which really would be the old normal? This is what we've been seeing over the last 40 years. That's the new normal, but it's not what we've historically seen. And the market's trying to adjust to this, that we might be in a climate of higher interest rates. Here's the 30-year yield, which hasn't come back up to this previous high yet, but it has been climbing. And then we compare the S&P 500 with the yield of the 10-year, just showing how the S&P is really underperforming. Junk bonds, still in an uptrend, but have been seeing some weakness. Then we look at a ratio between junk bonds, which are riskier but give you a better return, with the bond ETF, which are government bonds, more conservative bonds, and junk bonds continue to outperform. Here's a chart of the 7 to 10-year bond ETF, where we've seen a recent death cross. The RSI is below 50, even though it bounced back up slightly. And on a momentum basis, the MACD is also negative. So bonds based on price are clearly in a downtrend. Here's a daily chart of the different yields going from 3 months out to 30 years, showing over a period of time how interest rates have been going up, even though we have a lot of inverted yield curves. Here's a weekly chart looking internationally, with the US having the highest yield right now, followed by the UK. In blue is Germany, and even Japanese rates have been going up. Those are the ones in red. We look at the MOVE index, which has been going up as bonds have been under pressure. This measures the volatility of bonds. We have the VIX, which is going up, and that's measuring the volatility of stocks. And their correlation is fairly strong that they're having a tendency to go in the same direction. Then we look at a monthly price chart of the 30-year bond, where it continues to be in a downtrend. But when we do a ratio between bonds and the CRB index, and this takes a long time for this to shift over, bonds based on price have been outperforming, but this is rolling over. So longer term, if this crosses below the red line, that would turn things even more negative for bonds. We look at different sectors and compare them to the S&P. The materials are in a downtrend. The communication, one of the stronger areas in 2023, that's in an uptrend. Energy, which had been in a downtrend, is starting to roar back. And some of this is geopolitically induced because oil prices are really going up, and that's helping the energy sector. The financials, we had the banking issues come out in March, and the market is still wondering, is there going to be more still to come? So the financial sector is underperforming the S&P. The industrials are in a downtrend. Tech sector, another stronger area in 2023, is still in an uptrend. Staples have been really weak compared to the S&P, even though they bounced back recently. Real estate continues to be in a longer-term downtrend. Utilities also under a lot of pressure. We also look at a ratio between the S&P and utilities. When this is going up, that tends to really help the S&P. It's now starting to come back down as the S&P has been under pressure lately. Healthcare also continues to be in a downtrend, and here's another chart of healthcare showing how it's underperforming the S&P. Discretionary, which has been a stronger area in 2023, this is a little bit of a concern as it's really been starting to underperform the S&P, even though it's in a longer-term uptrend. The staples sector, which held up better in 2022, it's in a downtrend in 2023. The tech sector is still in an uptrend, even though we've been seeing some weakness. We look at the semiconductors, also coming down to its 200-day moving average, still in an uptrend, but showing some weakness. The tech to S&P ratio shows that tech is still outperforming the S&P. Energy is starting to make a comeback. It's not quite there yet, but this ratio, when you compare it to tech, could give us a golden cross here soon, but it's not quite there at this time. We look at growth stocks, which are outperforming bonds, and that is where a lot of the strength has been coming from in 2023. We look at the tech sector and then compare it to the rise in interest rates, where the tech sector had been outperforming. While as interest rates have been going up, the tech sector is now starting to underperform. Here's an inverse of that same chart showing how the rise in interest rates is outperforming the tech sector currently. Discretionary to staples, discretionary tends to be more growth area oriented, where staples are more value oriented. We're seeing some weakness in this ratio, but still discretionary is outperforming staples. Here's an inverse of that same chart where staples are underperforming, but bouncing back lately. Gold, which is starting to spike up because of geopolitical events, it's still in a longer-term downtrend when you compare it to the S&P, but it has been shooting up lately. And the dollar's been strong, but gold's been a little bit stronger lately as it's starting to go up, but overall it's still underperforming the US dollar. High leverage loans, which continue to hold up quite well, and if we were really getting ready to have some problems in the economy, this would not be going up the way it is in a pretty solid uptrend. These are risky loans, and if they were to become even more risky, you would think this ratio would be, or excuse me, this index would be going down. It's not doing that. The NYSE composite been chopping sideways, getting close to a death cross here, but still in a rather weak uptrend. All stocks also showing some weakness in an uptrend that could be starting to weaken. Emerging markets are in a downtrend now. They were all the rage earlier in 2023, but now they've kind of fallen out of favor. The micro caps have been under a lot of pressure lately, and they're pretty much setting a new 52-week low each day. We look at the home builders, where we compare that with the S&P on top. Here's the home builders ETF. Both have been under a lot of pressure. The ratio is going down, and they're having a pretty strong correlated relationship. So we're not necessarily getting any additional insight. When we get down into these yellow areas, that's when we really pay attention to this chart. Bitcoin, which should be in a period of positive seasonality, it's bumping up a little bit and it's getting up into the 30s, but it's still in a longer-term downtrend. And we look internationally. China's trying to make a little bit of a bounce, as are emerging markets. Europe is still more in a downtrend, where Japan's turning up and the US has been trying to turn up lately. This is the KST, which is a very long-term oscillator that can take some time for this to really shift. Then we look at InterMarket Analysis going back to the beginning of the year, where we finally have now seen oil surpass stocks in 2023 for performing. The black line are stocks. Then we have gold going above the dollar, and bond prices continue to be negative. Some different correlations. We're pretty much neutral when we look at the S&P 500 to the US dollar. When it gets to this red area and all the way up to the blue area, that means they're pretty much neutral. They're having a slight tendency to go in opposite directions, since we're below, a little bit below this 0.25 area. Then we look at the correlation between the S&P and oil. Oil going up can be positive for the market, but because it's more inflationary, and the reason why it's going up, that's producing some concern. As oil goes up, stocks have been going down, and we're seeing that reflected in this correlation. They're going in opposite directions. We look at the S&P to the 10-year yield, also a tendency to go in opposite directions. Interest rates have been going up, stocks have been going down. The tech sector, also some pressure in the tech sector as interest rates go up, so we're seeing this correlated relationship going in opposite directions. Then we look at the 2-year yield. This is pretty much neutral currently. Then we look at the long-term secular, which can be decades, and cyclical trends. A cyclical trend is usually a few years. Where we look at a monthly chart of the NYSE Composite Index, it's dropping below this longer-term moving average. That's a little bit more negative. The Kopic curve, which is another momentum oscillator, it's still above zero, but also starting to roll over. This could be longer-term negative. We look at a daily chart of the NYSE, where we measure on the bottom a thing called the NYSE Record High Percent Index. It had been going up, which was positive for stocks. Now it's really starting to come back down. We look at the S&P on a monthly chart, where it's coming back down to its longer-term moving average, and the longer-term momentum had been positive, and now it's starting to cross over negative. And we look at a ratio between the S&P and the CRB index, where stocks are still outperforming. It can take a while for this ratio to actually change. Then we look at another ratio between the S&P 500 on a monthly chart of a global index. I don't really look at the KST as much down here. It can give you some kind of crazy signs. What I look at is the price chart on top, where we're still above an advancing moving average. This is suggesting that the S&P is outperforming global stocks on a monthly, longer-term basis. Then at the very end, I take all of the things that are positive and list them. And my definition of positive is when the 50-day simple moving average is above the 200-day simple moving average. We have growth indexes and ETFs, which are positive, the CRB index, the dollar, mega caps, the Dow Jones Composite Average, the FANG, and ARK, even though we're seeing some weakness and close to turning negative with ARK. When we look at high yield, which means junk bonds, as well as the junk bonds index that we look at, tech and semiconductors, high leverage loans, the Dow and mid caps. The mid caps are starting to cross over negative now. The NASDAQ and NASDAQ 100 seeing some weakness, but still longer-term positive. The NYSE Composite could be turning more negative if we see more follow-through weakness. All stocks. And then negative, this is when the 50-day simple moving average is below the 200-day simple moving average. The value indexes are still negative. Gold and silver, even though they've been popping up lately based on the geopolitical events that are happening. Copper's in a downtrend. The Japanese yen, the euro, and the British pound all compared to the US dollar. The dynamic software index, that is turning more negative now. That's tech, and that's big software companies, and that's quite negative. The low volatility ETF is negative. Staples, the total bond ETF based on price, world bonds, small caps and micro caps are negative. And we could also add mid caps here. That changed this past week. Emerging markets, Investment grade and corporate bonds, these are more conservative bonds that don't give as high of a yield. And the Bitcoin index is seeing a little bit of a pop, even though it's still generated a recent death cross. Thank you. I hope you found this helpful. Please feel free to check out the daily videos and the weekly video that I also post. After this, I'll be preparing what I call the deep dive video, where I go through a bunch of different charts that I really didn't talk about this past week. Have a really nice weekend, and I will talk to you in the next video.